Okay, so this is for the subject investment and portfolio management. Here we have an article from Investopedia.com, and the topic is capital asset pricing model. So don't remember if I already did a video on this, but I think I already did under the subject capital markets. Anyway, we'll go through this again. So essentially, yung capital asset pricing model, asset pricing, it's a way to, measure whether an investment is worth it or not. Okay. So, itong capital asset pricing model, it describes the relationship between systematic risk and expected return for assets, particularly stocks. Okay, so this one is applicable mainly for stocks, alright? Widely used throughout finance for pricing risky securities and generating expected returns for assets given the risk of those assets and cost of capital. So in a way, ito yung ginagamit nila para malaman kung yung isang particular investment ba ay currently overpriced, or is it fairly priced, or is it underpriced. Okay. And depending on the result, saka lang sila, of course, mag-decide whether to invest or whether to get this investment or not. So normally, kapag overpriced yung isang investment, then it's not very attractive to get, right? Kasi kapag overpriced yung isang investment, the expectation is that the price of this investment is still going to go down kasi nga, if most investors see this as overpriced, then the demand for that particular investment or security will go down. And when it goes down, the market price will go down. Eventually, it would come to a point kung kailan magiging siyang, fairly priced, and it is at that point na karamihan ng investors would be encouraged or would think that this investment is already fairly priced, so, pwede nang bilhin, or marami na ang possibly bibili ng particular investment na yun. Excuse me. Alright. So just in case, marami pa sa atin na not aware na itong risk and return. So, di ba, investments, may kaakibat yan na the particular risk, and then iba't ibang risk actually. And then, of course, there's a corresponding return then depending on how much risk those investments are having. Okay? And later nga, discuss natin yung risk-return trade-off na yan. Alright? So, balik tayo sa Apm, Capital Asset Pricing Model. So, ito yung formula niya. The expected, the expected return of investment, ER sub I, equals the risk-free rate plus the beta of the investment multiplied by the expected return in the market minus the risk-free rate. Okay? So essentially, itong part na to, expected return in the market minus yung risk-free rate, so that is what we call the market risk premium. Okay? So, paano nga ba yan? So, investors expect to be compensated for risk and the time value of money. Okay? Yung risk-free rate na tinatawag dun sa Apm formula natin, it accounts for the time value of money. Okay? Kasi kumbaga, parang if you did not invest your money and you use it to consume products currently, so kumbaga, ayan, nagamit mo na siya, right? And then yung value niya would be equivalent to the risk-free rate. Kasi kumbaga, you instead of using it for consumption currently, nilagay mo siya dun sa investment, right? And yung risk-free rate is essentially the minimum amount that you could get from your investment. Risk-free. Okay? So, kumbaga, walang masyadong risk na kaakibat yung particular investment na yun. And normally, yung rate na ginagamit nila dito would be the existing rate ng government bonds or ng treasury bills. Okay? So, it's either going to be 2% to up to 4%. Okay? Kasi nga, kumbaga, in a way, medyo guaranteed yung returns doon since the government is being funded by taxes anyway. Right? So, again, itong risk-free rate dito is the rate for the government bonds. Okay? Tapos itong, what do you call it? Expected return on the market. Ito yung pinakang index, di ba? We have the stock index, we have the bond index. But since this is normally used for stocks, ito yung index ng, what do you call it? Stocks ang ginagamit dito. Okay, so this would depend on the performance of, let's say, the PSEI, Philippine Stock Exchange Index. Kung ano yung rate nun, minus mo yung risk-free rate, that would be your market risk premium. And then we have the beta of the investment. Ano ba yung beta? Beta is the measure of how much risk the investment will add to the portfolio that looks like the market. Okay? So, kapag yung stock is riskier than the market, ang beta niya would be greater than 1. Kapag equal siya dun sa market, 1 siya. Okay? Pero kung if it's riskier, the beta would be more than 1 or greater than 1. Okay? If a stock has a beta of less than 1, the formula assumes it will reduce the risk of the portfolio. So, essentially, kumbaga yung beta, it talks about the riskiness of the asset or the investment as compared to the market. Okay? So, in a way, kaya yung market dito, in-account din. So, kinuha yung market risk premium compared, multiplied mo by the beta of the investment. Again, the beta is, the riskiness of the assets as compared to the index. And then you have your, add mo ulit yung risk-free rate. And then that should be the expected return of the investment. Ngayon, kung yung historical return on a particular investment is less than this one, the expected return of investment, then essentially the decision or in the decision-making process, ang magiging result niya is that you're probably not going to invest in this particular asset or investment kasi nga mas mababa yung kanyang naging performance compared to your expected return ng investment. Okay? But if the performance is, or if the projected performance is, higher, then you could probably go ahead and pick up that company or particular security to add into your portfolio. But again, this is just an estimate din kasi syempre, there are other factors na pwedeng mag-appear in the future that could affect the actual return of the investment. So again, this is simply a measure of, expected return of investment. It's not exactly the actual return on the investment. And of course, the actual return could be affected by other factors. But then, like, let's say, you have your pandemic, your financial crisis, you have the movements in the economy, even in a normal economy, yung tipong walang pandemic, walang financial crisis, it would depend on which types of investments would be prioritized by the government or by the private sector. Okay, so in that sense, that could affect the actual return on a particular investment. And again, it would depend na din on the particular investor or the fund manager kung if they would go ahead and acquire a particular security to add in to their portfolio. But in a sense, pwedeng maging guide nila itong CAPM. But again, it's just a guide. It's possible that it would be used or pwede rin namang ignore if you take into account other factors as well. Alright. So, ayun lang. Stocks beta is then multiplied by the market risk premium. Ito na nga. Beta multiplied by the risk premium. This part here is called the risk premium. Ayan. So, ito yung example. Balikan natin. The goal of Sapien formula is to evaluate whether a stock is fairly valued. Yan nga. Para malaman kung overpriced ba siya or fairly priced or underpriced ba yan. When its risk and the time value of money are compared to its expected return. So, example. Stock worth $100 per share pays a 3% annual dividend. The stock has a beta compared to the market of 1.3, which means it is riskier than a market portfolio. Also assume that the risk-free rate is 3%, and this investor expects the market to rise in value by 8% per year. Okay, so yung expected sorry. Parang medyo mas malakas yun. The expected return of the stock based on the CAPM formula is 9.5%. Okay. ito siya, yung risk-free rate, this one, 3%, plus the beta, 1.3, multiply the risk premium. Yung risk premium is yung the market 8% minus the risk-free rate na 3%. So, 1.3 times 5% plus 3% is 9.5%. So, that's the expected return on the stock. Okay. The expected return is used to discount the expected dividends and capital appreciation of the stock over the expected holding period. If the discounted value of those future cash flows is equal to $100, then the APM formula indicates the stock is fairly valued relative to risk. So in this sense, ito palang expected return ng stock mo. Of course, you have to use this with regards to the future cash flows of the company. Okay, but then again, sometimes, most of the time, you're not it's possible na hindi available yung information and the projected cash flow of the company. But you can probably base this on the historical data, but then again, the actual could be different, right? Problems with the CAPM. Several assumptions behind the CAPM formula that have been shown not to hold in reality. So, kumbaga assumptions na hindi naman nangyayari in reality. Modern financial theory rests on two assumptions. Securities markets are very competitive and efficient. So again, yung efficiency, relevant information about the companies is quickly and universally distributed and absorbed, which is, sometimes not really. Meron pa rin mga, individuals or organizations or institutions na nauuna na makatanggap ng balita. And then afterwards, they would, decide or make decisions depending on those information. Tapos yung mga iba, other investors, especially small investors, medyo nahuhuli sila makasagat ng balita. And then when they decide, kumbaga ay incorporated na dun sa market price ng investment yung information. And then these markets are dominated by rational, risk-averse investors who seek to maximize satisfaction from returns on their investments, which again is not true. For majority of the experienced investors, then this is true. Whenever they make a decision on where to put their money, where to invest, they are, in a way rational. They make actual analysis. They actually do the analysis themselves and not rely on, analysis of so-called experts or articles given out by other investors, okay, who may or may not simply be hyping a particular investment. Okay, so yan, and who seek to maximize satisfaction from returns on their investments. But let's go back here. Risk-averse investors. So kumbaga, di ba nga, investments, a company are accompanied by risk. But then you have your classification of investors, your conservative, moderate, and then you have your aggressive. But dito, yung assumption niya is risk-averse investors. It means that most of them are conservative or moderate investors in such that they try to avoid the riskier types of investments. But again, reality, medyo marami din naman ang mga aggressive investors who take on risky investments. Okay? So, ayun. So, those are some of the assumptions na does not hold true in reality. So, despite these issues, the CAPM formula is still widely used because it is simple and allows for easy comparisons of investment alternatives. Okay. In capital budgeting, ginagamit din itong CAPM. Essentially, yung what do you call that? Expected return on investment, the percentage. Yeah. Sorry. So, yan, including beta in the formula assumes that risk can be measured by a stock's price volatility. However, price movements in both directions are not equally risky. The look-back period to determine a stock's volatility is not standard because stock returns and risks are not normally distributed. Okay, pagdating sa statistics naman, we have the so-called normal distribution na kumbaga yung riskiness niya, both sides, hindi siya pareho. Normally, yung with regards to losses, mas malaki or mas mataas yung riskiness niya compared to the expected return on risky assets. Hindi siya ganun. Kumbaga, hindi siya equal, yung distribution niya. Ayan. Let's say yung isang particular investment With regards to the returns or the possibility of returns, risky siya na asset pero yung possibility ng returns niya maximum is let's say 100 pesos lang per share. Pero yung possibility of loss, let's say kapag hindi nag-perform na maayos yung what do you call this? Yung investment or yung security or yung company, yung kanyang possibility of loss is let's say 150 pesos. Okay, so kumbaga hindi siya normally distributed and such that yung loss niya, possibility of loss, maximum is 150 pesos per share, pero yung possibility of profit hanggang 100 pesos lang naman. Okay, so it's a very risky investment, pero hindi equal yung sorry, hindi equal yung riskiness niya with regards to the possibility of return. So, yeah. And the CAPM also assumes that risk-free rate will remain constant over the discounting period. In some cases, this could be true. Kasi normally, yun namang mga government bonds, hindi naman nagbabago masyado yung kanilang rate. It's almost the same, maximum up to 4%. Rather not. The market portfolio that is used to find the market risk premium is only a theoretical value and is not an asset that can be purchased or invested in as an alternative to the stock. But, PSCI, it's available. For most of the time, investors will use a major stock index like the S&P 500 to substitute for the market, which is an imperfect comparison, right? The most serious critic of the CAPM is the assumption that future cash flows can be estimated for discounting process. If an investor could estimate the future return on a stock with high level of accuracy, the CAPM would not be necessary, right? Which is true, okay? So, kumbaga, ito na yung, best possible way to compute for the expected return on an investment, alright? Apm and Efficient Frontier. Using Apm to build a portfolio is supposed to help an investor manage their risk. If an investor were able to use the Apm to perfectly optimize the portfolio, cannot say perfectly optimized, not really. Return relative to risk would exist on a curve called Efficient Frontier, as shown on the following graph, which is this one. This curve is called Efficient Frontier, Ideal Market Portfolio, Optimal, and then yung capital market line is just here, risk. Lowest rate would be the risk-free rate. Okay, tapos you have your other investments here, inferior compared to the ideal market portfolio. Sorry. Kapag tagal kong magsalita, mas dalas ang pagbato. Okay, anyway. Let's skip this part here. Kasi hindi naman siya masyado, what do you call it? Hindi naman masyadong na-apply. Trade-off between risk and return applies to Apm and the Efficient Frontier graph can be rearranged to illustrate the trade-off for individual assets. Okay. The CML, what's the CML again? Capital market line. Okay. The CAPM and SML make a connection between a stock's beta and its expected risk. A higher beta means more risk, but a portfolio of high beta risk could exist somewhere on the CML where trade-off is acceptable. Okay, ang mahalaga naman kasi, yung portfolio mo is composed of various securities na nag-offset yung kanilang risk. Hindi pare-parehong mataas ang risk. You have your, high risk, you have moderate risk, and you have your low risk investments in a portfolio. The value of these two models is diminished by assumptions about beta and market participants that aren't true in real markets. So, yun yung mahirap dito kasi nga, you have your theories, you have your measurements, pero yung reality is different from the assumptions being used in these models. Kaya, in a way, hindi siya ganun ka-reliable. But, the fact is, there's no measurement that could be that can be relied upon naman. So, kumbaga, they're the next best thing. They're the next best thing. So that's why, ayan, pinag-aaralan pa rin natin. For example, the beta does not account for the relative riskiness of a stock that is more volatile than the market with a high frequency of downside shocks compared to another stock with an equally high beta that does not experience the same kind of price movements to the downside. Okay? So example natin kanina na, 100 yung maximum na profit, 150 yung maximum na loss. So dito, sa isang ito, kumbaga, binanggit doon na two companies could have the same beta. Okay, kasi kumbaga yung beta parang average riskiness ng isang particular stock. But when it comes to the distribution, pwedeng magkaiba sila nung, the range on the distribution ng maximum profit and then maximum loss. Pero beta-wise, pag kinompute, halos magkapareho lang. Okay, but it does not mean that they're essentially the same. Magkaiba pa din. Okay, there are other factors that would make them different. Practical value of the CAPM. Considering the critics of the CAPM and the assumptions behind its use in portfolio construction, it might be difficult to see how it could be useful. Yes, I actually don't see. However, using this APM as a tool to evaluate the reasonableness of future expectations or to conduct comparisons can still have some value. Kasi nga, there's, no other measurement to do it. Imagine an advisor has proposed adding a stock to a portfolio with a $100 share price. The advisor uses the CAPM to justify the price with a discount rate of 13%. The advisor's investment manager can take this information and compare it to the company's past performance. Ayan, normally, historical data pa rin yung pinagbabasehan or naging comparison. And its peers or yung competitors ng particular corporation na yun, or kumbaga yung industry average na, to see if the 13% return is a reasonable expectation. Assuming this example that the peer group's performance over the last few years was a little better than 10%, while this stock has consistently underperformed with 9% return, so the investment manager shouldn't take the advisor's recommendation without some justification for the increased expected return. Kasi kumbaga, historically, 9% up to 10%, pero yung na-compute niya is, 13%. But you have to explain. Kumbaga, you have to justify bakit up to 13% yung naging expected return. Ano yung possible factors that contribute to a higher expected return na 13%. Okay? When historically, hanggang, 9 to 10% lang naman. Right? Meron ba silang, additional projects? Meron ba silang business merger with another company? Are they acquiring another company? Or did they, did they report a higher earning recently or something? Something like that. An investor can also use the concepts from the Apm and Efficient Frontier to evaluate their portfolio or individual stock performance compared to the rest of the market. So, example niya dito, portfolio has returned 10% per year for the last 3 years with a standard deviation of returns of 10%. However, market averages have returned 10% for the last 3 years with a risk of 8%. So, yung investor could use this observation to reevaluate how their portfolio is constructed and which holdings may not be on the SML. This will explain why the investor's portfolio is to the right of the CML. If the holdings that are either dragging on returns or have increased the portfolio's risk disproportionately can be identified, the investor can make changes to improve returns. So yun nga, yung mga underperforming na investments in your portfolio could be, removed or replaced kapag na-identify mo ng maayos kung alin bang investments yung ganon. Yung underperforming compared to, the benchmark or the market. Bottom line, APM uses principles of modern portfolio theory to determine if a security is fairly valued. It relies on assumptions about investor behaviors, risk and return distributions, and market fundamentals that don't match reality, diba? Ito yung drawback dito. However, the underlying concepts of APM and the associated efficient frontier can help investors understand the relationship between the expected risk and reward as they make better decisions about adding securities to a portfolio. Alright? So, ayun lang naman. So, essentially, kumbaga, next best thing, hindi siya ideal or hindi siya realistic or to be used, but there's no other model to be used. So, like that thing. And then, next topic natin, risk return trade-off. Alright, so that's it for this one. Thanks and bye.